The Nigerian stock market was described as one of the best in the world in 2017. Of course, you've seen the report before the year finished off. And today, Bloomberg reports also that Africa's debt market was one of the best hunting grounds for investors globally in 2017 because we provided decent returns to investors despite the currency volatility in some of the markets across the continent, in South Africa in particular, and a few other countries around us. And of course, the issues around commodity prices. But overall, equities and fixed income was debt market was very nice across Africa, generally speaking, in 2017, and Nigeria was part of the lead in light of that. So let's give ourselves a handshake for that as we start a brand new year with Tola Abimbola, an investment analyst from Afrinvest. And I'm taking all my handshakes this morning. Thank you. Let's start a new year with us.
Good morning.
It's good to have you.
My pleasure.
A very nice year when all the news are coming in that, yes, it was good across all frontiers, as it were, for us. But Nigeria is sharing in that a glorious year for 2017. But let's take a look at 2018 and read the market tea leaves for us. The rally that we had last year on the equity side was one of the best in about a decade since the market melted down in the first quarter of 2008. So remind us what were the fundamentals behind the 2017 good year that we had.
Indeed, we had one of the best performance globally in 2017, and that is no mean feat because 2017 was a generally positive year for the global markets. If you look at the performance of risk assets across developed markets, from continental Europe to the UK, to the USA, even to Asia Pacific region, it was a generally bullish performance, driven by the fact that we have been in a phase of synchronized global growth and expansion. We are seeing growth momentum, strengthening all across the globe. We're also seeing accommodative monetary policy by major, central banks like the ECB, the Bank of Japan. The US Fed is tightening a bit, but if you still look at the real interest rate, is still negative rather. So generally, it was a very strong year for risk assets in the global market in 2017, and Nigeria to have been able to outperform in such a good year is a positive thing to note. And talking about the factors that drove the performance of Nigerian equity market in 2017, I would say it's a combination of some favorable cyclical, rebound in some business cycle anchors like oil price and crude oil production, and also partly driven by some major policy reforms implemented by the Central Bank of Nigeria and also the fiscal policy managers as well. 2017, we saw a rebound in commodity prices, particularly oil. And as you would know, oil production and crude oil prices, they are two of the most important macroeconomic, anchors in Nigeria, and for most frontier markets anyway. So that was the major factor that boosted Nigeria's external reserves. It increased FX liquidity and also gave the CBN the confidence to engage in liberalization of the foreign exchange markets, which culminated in the April 2017, opening of the investors and exporters window. Immediately we saw that happen. We saw investors, particularly foreign investors, coming back to the Nigerian markets, and we saw a gradual repricing of Nigerian equities. So we saw price to earnings of Nigerian equities rising from around 11 to 12 times at the beginning of the year to nearly 14 times by the time the year ended. Also, if I may add, I think the fact that earnings of companies have been resilient as well was also a major driver. If you look at the banking sector, we saw earnings being driven by high interest rate environments. If you look at the consumer goods and the industrial goods sectors, we also saw earnings, rebounding significantly in those two sectors, driven by increase in products prices and the fact that we are seeing lower inflation rates and margins are expanding, overall. So all these factors were the drivers of the significant positive equity return in 2017.
FX and FX and FX and FX. FX was the top story. But if you look at the CNN Money report, and it has it there, the online says there's still the outlook for 2018 for Nigerian equities is still very strong. Indeed. In 2018. in this new year. So that's what we fight. Do you think the FX fever of the IE window, we're heading towards the first anniversary of that window in April, so we'll still have a few months to go. Do you think this will likely fizzle out?
Well, I believe that the outlook for the market, or rather we believe that that's for the market in 2018, is still positive, but the driver of performance, I don't think it will be the high and heel window any longer, you know. I think we've already seen the high and heel window rally taper out towards the end of last year. 2018, if you're looking at valuation multiples of the Nigerian market compared to other frontier markets right now, you'll see that the premium has reduced significantly. So there is no arbitrage to explore again regarding valuation multiples. But 2018 returns will be driven by what happens to earnings. It's going to be earnings, 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 earnings. And on earnings, we're also very positive on that because we are already seeing a slow but steady rebound in the economy, which is happening already. We are seeing inflation rates moderate. We are seeing FX stability. All these things are positive for margins of companies. You know, so as we are seeing margins, you know, continue to expand in 2018, as we are seeing revenue, you know, also improve because of the stronger, you know, growth outlook. I think for us, we still think earnings will still grow by double digits in 2018, and that should drive the market's return.
Fantastic. So give me your top, give me your top risk factors for equity investments.
There are two major risk factors, or rather, let me say three major risk factors in 2018. The first is political uncertainty. Number two is policy-induced volatility.
And number three?
And number three is commodity prices.
Okay, let's start with number one, politics. Okay, yes.
Yeah, we are approaching the 2019 general elections, as we all know. It's only a couple of months away, about 14. It's taking place in February 2019. So we're just about 14 months away from it. I'll be seeing the primary elections for the major political parties taking place in the second half of the year. You know, and typically, if you look at the performance of the Nigerian equity markets, and in fact, most frontier markets, if you look at what happened to Kenya and South Africa in 2017, where we saw the political uncertainty affecting asset prices, typically in frontier markets, during political cycles, we see asset prices, you know, underperforming. And we don't think Nigeria will be any different in 2018. So as we're approaching the primary elections toward the end of the year, we should expect to see some volatility, you know, in the economy towards that period. However, if we are able to, you know, marshal our way through the primary elections without seeing any major violence or any political violence outbreak, I think we'll still be able to see decent return for 2018 for equities.
In terms of the political, I'm sure the president was also aware of this because he is also someone who is one of the country's political heavyweights. So he put it in his speech yesterday in his New Year address that electioneering will be a key issue for 2018. But of course, that Bloomberg report this morning also said that one of the key issues for Nigeria, and speaking to Nigeria specifically in that online report by Bloomberg, was that, look, if the economic managers and the policy masters, country's political masters, leave economy unattended and focus more on winning primaries and all of that, that could have very serious consequences for us.
That's a good point. And another thing to notice is that during political cycles, we have observed that frontier markets economic policymakers, they typically adopt a very short-term approach to economic policy making. So instead of embracing much more important structural reforms that will be important for long-term growth, but that are very, very painful, you know, they would rather take a very short-term perspective and delay very important reforms. A very important example is what is happening regarding the energy sector in Nigeria today. You know, we are seeing shortage of petroleum products in the downstream sector. And a major reason for that is the fact that we still don't have a deregulated market yet. So now, this is a very important reform, but embarking on the regulation of the downstream oil and gas sector right now will lead to increase in petroleum products prices, which the federal government might not be, you know, willing to allow to happen towards the election cycles. You know, so I'm sure you've read this yesterday or 2 days ago. Saudi Arabia did an increase in their energy petrol prices as well as power tariff.
Yeah,
so we need to see power tariff go up to encourage investment in the sector. We need to see a proper deregulation of the downstream oil and gas sector. But these two major reforms, they are very unpopular.
And they are intertwined.
They are intertwined indeed.
Petrol and power, they form the entire energy crux for every conversation we're having.
Correct.
But these are very volatile and very highly inflammable conversation when it comes to that. Nobody wants to touch that in a year when you want a return to power or stay in power or get elected for the first time.
And that leads us to our second major key risk for the market in 2018, policy-induced volatility. There are some major structural reforms that needs to happen, right, in 2018 to avoid Nigeria going back into recession. But with the political, cycle gradually approaching, we do not expect those things to happen, and they're going to have long-term consequences.
Give me one. Mention one.
Energy sector, the major one which I've mentioned, and the second one is the harmonization of rates in the FX markets. Already, the CBN has taken a very important step by trying to allow for transparency, in the investors and exporters window. But we are still seeing the official peg, remaining unchanged from 305, and this is still a very significant spread. And even at the 305 official peg, the government is still having to pay subsidy on petroleum products importation. So I think for 2018, we're likely not going to see that important harmonization because, like I mentioned, it's still going to have a feedback on petroleum products prices. Okay,
we'll have more time on the show to still break this down a little bit further. But if we go back to the political cycle and on the electoral promises, the president made lengthy promises yesterday.
Indeed, indeed.
Yes, I think it's about almost how many pages of a speech he delivered. He was very long on promises, especially road, rail, and power. So if we look at the electoral cycle, do you think the president and his team will be able to deliver on very critical infrastructure that they've set himself up against the wall, as it were, in 2018 into 2019? Of course, some of the rail will have to be delivered in 2019, but everyone will be looking forward to see some good progress reports by the end of this year.
Yeah, definitely. Like you mentioned, for the President's New Year speech, he made some remarks regarding the infrastructure plan for the federal government, talking about the delivery of major rail infrastructure, roads, as well as power as well. And these are all very positive. In 2018, there'll probably be more than 1,000 megawatts of power added to the generation capacity of Nigeria, coming from Azura, coming from Kaduna, coming from our farm, etc. So these are very, very important infrastructure projects. Also, we are seeing some major rail infrastructure, Kaduna to Lagos, the Abuja City Light Rail projects, inception of the Lagos-Calabar routes, as well as the Port Harcourt to Kano route as well. So these are very important infrastructure that the federal government is trying to deliver on. But if you look at the funding structure for the infrastructure projects and the fact that the deficit the country is facing on infrastructure is so massive that all these, deficit-funded projects might not be able to budget significantly. There is still a need for the federal government to make reforms regarding pricing, regarding taxes, and regarding the overall economic framework so as to enable private capital to come in to fund these projects.
I was just about to say that. And then I watched a similar presentation by the Indian finance minister a few weeks ago about their own road and rail a project massively over the years and what they intend to do. And I saw in that presentation, which was very lengthy on satellite television, about where the private sector comes in, how much the government is bringing in, how much the private sector is bringing in, what incentives the private sector gets for joining hands with the government to build those infrastructure. I'm waiting to see a bit of that. But we've seen some of the what's been mentioned about whether there will be tax incentive also for building roads in Nigeria. But do you think overall on the president's speech, the markets have something to take away from there?
I think what his speech suggests is that we're going to likely see another fiscal expansion in 2018 because we are now seeing a positive momentum in the oil markets, which is positive for fiscal balance. And the government still intends to do a lot of deficit funding in order to deliver on these projects. So it's going to be an expansionary fiscal year, in 2018 and possibly 2019 as well because of the entire electoral cycles, and they need to deliver on these projects before the election starts properly. However, like I mentioned before, there are still some very important reforms for the government to do. All the infrastructure being delivered, particularly on the rail and the road sides, they are still entirely deficit funded by the government, right? And so there is still a need for the government to create an enabling environment to allow for private capital to be able to invest in all these projects.
Whichever deficit you're talking about, it's all about debt.
Indeed.
More debt. So
Indeed.
will Nigeria's debt burden worsen in 2018?
Likely it's going to... there is a possibility that might happen, because of the urgency the federal government is embarking, because of the urgency in delivering on infrastructural projects before the election cycle starts. However, because we are seeing a stable increase in oil prices, we have seen FARC allocation to the different subnationals as well as the federal government's increase in recent time. At the beginning of the year, FARC distribution to the 3 tiers of government was around 400 to 500 billion naira per month. Right now, we're above 600 billion naira per month. So that's very positive and likely going to reduce the need or the urgency to embark on deficit financing for the fiscal year.
Well, we all know where FARC money goes. It goes basically into salaries and wages, right?
Indeed.
Okay, yeah, so we need money for infrastructure, and the president spoke about roads and rail that cost a mountain of dollars to build. So, so we're going to borrow money. And the DMO is talking about another $2.5 billion Eurobond in 2018. Yeah,
indeed. And that is also in line with the borrowing plan that they already guided towards at the tail end of last year. And for the DMO, the Eurobond that they will be doing in 2018 will be directed towards two major needs. The first one is to finance the government deficits, and the second one is to further reduce the high rates of borrowing in the local markets by trying to refinance existing treasury bills. Last year, the DMO, rather the Ministry of Finance, they did mention that there is a plan to substitute maturing treasury bills, or rather to refinance maturing treasury bills with about $3 billion of external borrowing.
Okay.
We've done $3 billion already in 2017.
Yeah, we did $500 million.
$5.5 billion, and the remainder, which is $2.5 billion, is expected to be done in 2018.
And that goes into refinancing the treasury.
Refinancing treasury bills as well as financing the government deficit as well.
So we still need a lot of money to meet those infrastructure projects.
Indeed, we do.
But again, what's the new horizons for fixed income here within this space? Do you think the government will be able to lean on the pension industry? Will it be able to lean more on DFIs to ramp up on this critical infrastructure spending?
Yeah, it's been an interesting, rather 2017 was an interesting year for the fixed income market. At the beginning of the year, we were seeing average bond yield on the government bond rather, at about 16% or over that. But towards the end of the year, the average bond yield was less than 14%. So we have seen over 200 basis points moderation, in yields in the fixed income market. And that rally in the fixed income market is being driven by three major factors. Number one is the federal government's fiscal plan to refinance higher domestic borrowing with much more cheaper funding sources in the global market, also driven by the CBN's almost strategy. In December, the CBN reduced, they stopped issuing normal bills for about a week or two, and that effectively guided down rates in the fixed income market. And the third factor is the fact that the market is expecting easing of monetary policy in 2018. So all these factors, they have led to a downward shift in the yield curve, which is favorable to the government as well, because it means they have to borrow at a much more cheaper cost, in 2018. And we still expect that to continue.
We don't see any negative yield return on Nigerian assets anytime soon. Am I correct?
Could you come again?
Yeah. Is it likely that we'll have a negative yield?
Negative yield?
Yes.
No, definitely no.
Not anytime soon?
Definitely no.
Not anytime soon?
Yeah.
So despite the outlook on inflation and the rate position of the central bank?
For inflation, in 2017, inflation disappointed a bit. We started the year at about 18.7%, and the consensus estimates, by analysts was that by the end of the year, we should be at around 15% or thereabouts because of the high base effects coming from 2015. However, if you notice, inflation moderated to about 16.1% in June 2016, and it has been very sticky at that level up to November. November was around 15.9%. So between June and November, we only saw like a 20 basis point moderation in inflation rates, since the beginning of, since in the second half of the year, essentially. And that disappointing inflation figure, there has been many theses regarding the factors driving it. One school of thought, says that because we have seen a depreciation, in the naira, then that means that neighboring countries to Nigeria, particularly in the Sahel region, have increased their demand for locally produced food items in Nigeria. So, that has driven exportation and also led to increase in domestic food prices. And that theory says that perhaps because of the restrictions we are seeing in the FX market for some important food imports like rice, like palm oil, etc. So that's it driving up, prices for food items. So 2017, we saw food prices, having a very high impact on inflation. But for 2018, if we do not see an official increase in petroleum products prices, or we do not see an increase in power tariff, as we expect, then that means that we should probably see further moderation in headline inflation in 2018. However, because of the political cycles and all that, there will likely be much more spending towards the fourth and third quarter of the year. So that could probably put much more pressure on prices in the economy. But if you look at consensus opinion, it still favors a downward moderation in inflation rates, probably by another 200 to 300 basis points before the year runs out. So on that basis of an expectation of lower inflation rates, we still expect the yields in the fixed income market to continue to moderate. And for us, we've been telling investors to position at the longer end of the curve, locking the durations.
A number of people are not really happy with you folks in the financial market because it looks like the entire 2017, the central bank actually make things work very nicely for those, for those of you living. The rest of us who are on the main street, on the other side of the street. So do you think the central bank has done enough for the market street and should now begin to think of what to do for the main streets where we have the main economy, the small and medium enterprises, and how all these PMIs should begin to have some meaning to the man on the street? I am one of the men on the street. Yes.
Well, the CBN governor has a very difficult job. He has to balance the need to stimulate much more private capital into the economy. That is to balance to create stability in the FX market, along with the need to also support growth in the economy. And it's a very difficult job, but overall, I think they've been able to manage it quite well in 2017 by approaching and by adopting an approach which is uncommon for central bankers, which is indirect financing of some major projects. So we saw the central bank governor, the central bank rather, increasing its development intervention, such as the agri sector and co-borrowers program. We also saw some major the power sector guarantee, around 700 billion naira power sector guarantee to support liquidity, in the power sector, the power stability fund, etc. In order to stimulate the economy. But for 2018, I think you Main Street folks, it should be a good year for you because already we have seen a downward moderation in yield in the fixed income market. So banks will likely, be much more aggressive in terms of growing their risk assets, because of the lower yield on government securities. So it's going to have an impact on credit rates as well in the economy. But even further to that, 2017 was all about market yield moderation. But 2018, if the momentum we are seeing in the oil market, if it continues, and we continue to record very high level of crude oil production without any attacks on oil installation by Niger Delta militants, then there should be a justification for official rate cuts.
Official rate cut.
At least by Q2 20.
And that's what everybody, and I've been waiting for you to say it since you've been here almost 30 minutes or more, and you haven't said that. Because I was looking for that magical phrase that the Ministry of Finance, the Ministry of Industry, Trade and Investment, and others can take to the manufacturing, the industrial, the real sector to say, look, Godwin Emefiele and the rest of your team, thank you very much. You've made everybody on Broad Street very happy. 2016, 2017, they've had a very decent time. They've made money on all these financial assets, stocks, bonds, whatever, mutual funds, what have you, PFAs. So is it time for us to go very heavy on the economic side, on the main economy side? Because again, if you're doing massive infrastructure, you also need to create jobs at the, and not more jobs is being created on Broad Street anyway. So well, at least we all know that. Yeah,
definitely. There's a very solid argument for monetary easing to support economic growth, because growth so far in 2017, at least up to Q3, has been quite slow, and it's been very sluggish as well. We saw GDP growth as 1.4% or thereabouts in Q3, and the growth has been driven by the oil sector, the non-oil sector, particularly the services sector, which is the second largest employer of labor after agriculture, is still in recession. So that's a very important, variable for the federal government to look at, and that's going to spur more discussion on probably adopting a much more easy monetary policy in 2018 to stimulate growth. However, while we are expecting a possible official rate cut in 2018, we do not think it will be significant because of two major considerations. Number one, if you're looking at the major systemic central banks globally, they are already exiting accommodative monetary policy phase because of the strong growth they are recording. The US Fed, they hiked the federal fund rate 3 times in 2018. In 2017, rather, there's an official guidance that in 2018 there will be 3 additional, rate increases. The ECB, the European Central Bank, they have cut down their asset purchase program by 30 billion euros, from 60 billion to 30 billion euros. And there's an expectation that before the year runs out, as 2018 runs out, they would have completely exited quantitative easing. So there will be probably much more discussion on possible rate increases. If you are looking at the Bank of Japan as well, there are also talks that they will probably reduce the asset purchase program, while in China, they are gradually reducing their policy support, for their industrial manufacturing. So all these things point to a much more tighter external financing condition.
But we should be easing and not tightening. I'm not sure many of my viewers would want to like you for tightening coming on the 2nd of January to say that.
There wouldn't be tightening, definitely.
So we should be easing. So we need policy accommodating here.
We do, but the pace of easing will likely be, let me say, underwhelming because of that major condition I mentioned. Because if you are seeing a tightening of financing condition externally, it's going to have an impact on your FX market. And the CBN's objective, like I mentioned, is to balance those two things, domestic stability and FX market stability. So in as much as they want to stimulate growth, they also have to pay attention to what's happening, in the FX market as well.
Which we have very little control over anyway.
Exactly, because of commodity prices.
Yeah, we don't print the currency of which our commodity is sold. Our main commodity, that is. So we just produce crude, but we don't have control over the price, the currency, which is tight.
And maybe an additional factor for monetary policy in 2018 is that, besides the fact that we are seeing tightening of global financing condition, because of the upcoming election cycle, we are going to be seeing higher spending by political parties and fiscal managers as well. The CBN will be cautious enough.
That's good news to the man on the street. I think Nigerians just look forward to the election year because of the money that is being spent. But that's not for you, for you not in the political arena. Let's keep you around for the last part of the segment to look at the first trading day in 2018. If you are going to pick some stocks that goes up, those that will go down. That's coming next. Stocks go first in 2018, the first trading day of the year, and I'm looking for some good news. Rotimi Fakayejo from Enterprise Stockbrokers giving us about a minute or two into our pre-open this Tuesday. Rotimi, good morning. It's good to see you, or to hear your voice in the new year.
Good morning. It's my delight hearing your voice too. It's a good and new year.
Thank you very much. Let's have some time later to discuss the new year. Let's discuss the stock market for the moment. We have about 1 minute or two. What's the pre-open looking like this first day?
It's looking positive. So far, the market has traded about 250 million naira value, and it's done about 0.02%, and that is very, very good one to start with on a day like that.
And give us the sectors driving this about 0.2% drive or uptake in the all-share index.
Basically, is the banking sector, and we believe that the other sectors will also prove more positive as we continue. But we believe strongly that we should be able to start the year running at least on a good note like this.
Looking back at Friday, Rotimi, it looks like investors' sentiments, negative sentiments against the oil and gas stocks look a little bit tapering off. Perhaps they are getting a little bit comfy with the availability of petrol.
Yes, I think although we saw Seplat, we saw Mobil, and I think and the two of them actually popping up some figures and having a very good one. The Seplat closing at over 600 naira for the first time since a very long time after it was listed. And I think for me, the scarcity in the market is making people to be hesitant about the stock, and we also hope that definitely the scarcity as it subsides, then there will be a response to that sector. But for now, everybody is just very indifferent to this sector.
Rotimi, what do I wish you in the new year? A very good time, and do make more money. Rotimi Fakaija from Enterprise Stockbrokers. Let's wrap up the final 2 minutes with Tola Abimbola from Afrinvest, is an investment analyst. So what's your take on what you've heard so far? You happy with the market takeoff point?
Yeah, comfortable with it.
Comfortable with that.
Yeah.
So what are your sectors? You're not surprised it's the banks, as usual.
Definitely. I think in 2016, we told our clients to overweight fixed income because of the underwhelming equity return we were projecting. 2017, we also told clients at the start of the year to overweight fixed income, but after the honey window was opened, we actually overweighted equities over fixed income. For 2017, we are looking at an equally weighted, 2018 rather, we're looking at an equally weighted portfolio because right now, the returns we are forecasting for fixed income is a little bit lower now because of the moderating yield environment. While for equities markets, it looks as if the rally we saw in 2017 has reduced the potential return for 2018 as well. Now, for the sectors we invest in the equity markets, we still like banks, although we'll be overweighting the consumer goods and the industrial goods more over banks for the sectoral allocation because of the significant hike in products prices embarked upon by cement manufacturers and consumer goods giants in 2017. And now they'll be reaping the benefit of it because inflation rate is now moderating. So that's going to be positive for their margins and earnings outlook as well. For the banks as well, we still like the banks, although the reason we are still buying the banks is not because so much of the earnings because earnings are going to likely be flat in 2018 because of decline in the yield environment, but because the valuation multiples are still low compared to pre-crisis level. Okay. So there are still opportunities there. Okay.
That looks like a very nice way to put it. They're showing us give us some idea of what to do in the new year. Thank you very much for being with us here on the first trading day of 2018. Tola Abimbola from Afrinvest. That's the show for today. Let's go online. If you missed it, you can watch it later on YouTube and on channelstv.com. You know how to continue the conversation, don't you? On social media, Twitter, at Channels TV, at B's Morning, and at B Boson. And that's me signing off for today. I'll see you again tomorrow, Wednesday.